Stock charting gives you the ability to actually see what's happening without a media filter. It's not delusion, it's not illusion, it's reality. That's why the charts are so valuable, and that's what we do here every day is we cut through all the other things that are going on and focus on what's actually happening. Because in the end, all that matters is price. Let's get into the day. What do we see going on? We're going to start with our weekly charts on our two stock indexes. That's the S&P 500, up again 0.59%. NASDAQ 100 up big 1.41%. We see 20-year bonds up 0.61%. Gold down just barely 0.06%. So let's jump first, as we always do, into the S&P 500. We're going to start on this weekly chart, and we see that we have a strong weekly down candle still drawn there going through Wednesday now. We still have 2 more days until this candle will finally be completed. The all-important price percent oscillator heading down has not crossed over. Unless there's a big Thursday and Friday down moves, we're probably not going to see a crossover, but we'll wait and see. Derivative oscillator also losing lots of energy. And again, this is a strong red down candle. No wick on the top as it was in the prior week. We just have all down movement. And again, a smaller wick on the bottom. So there's been, it's gone further, and the bulls have been able to pull it up a little bit, but not a lot. So again, trend is down, but has not crossed over. So we still call the market in an uptrend until we move our weekly vertical crossover over, once there actually is one. And until there's a weekly vertical crossover, we stay in the mood that the market is in an adjustment and may be moving back up again. We do not do down trades. Those who foolishly jumped into that after the big down move on Monday have since gotten a real comeuppance because they caught a falling knife, and now they've been stabbed. So let's keep moving through these charts. It's the reason we trend follow, my friends. Following trends is the safest and the best way to see what's actually going on and to be able to do successful virtual trades. I always say virtual trades because we're not a stock calling service, we're an education firm. Let's look at what's going on when we jump on the 2-day chart. What do we see there? Well, of course, we now have a completed candle. We had the first one at the beginning of the week representing Friday and Monday, Friday of the prior week and Monday of this week. This latest candle represents Tuesday and Wednesday, and we can see that it moved a little lower in the solid portion, but we can see a pullback there, not nearly as much of a down wick as we saw with the prior one. It's also reflected in the price percent oscillator not going down at the same stronger angle it had been. Derivative oscillator still gaining downward momentum. We go from the 2-day to the 4-hour, and that, of course, is where you see those pullbacks. We had an up morning and afternoon on Tuesday. We had a lots of indecision in the morning on Wednesday, and then a bigger up afternoon on the S&P 500. Derivative oscillators already switched over into the positive on that 4-hour chart. Price percent oscillator has not yet crossed over, so we'll continue to watch and see what we see. We want to see how things sort out. Remember, we have no trade on the S&P 500. Why? Because the weekly's in a confirmed up move and the 2-day's in a confirmed down move. That means we don't have a trend. That means we're not going to be foolish and do anything that is going to get us hammered. First rule of investing and trading, don't lose money. Second rule, remember rule number 1. Okay, let's keep pushing through. Going back to the weekly chart, I always start with the big chart, the biggest wave, bigger waves, bigger money. That weekly chart on the Qs, we can see we're going into our second week of strong, well, much stronger down movement in this second week. Big red down candle with a wick on the bottom. Price percent oscillator, similar to the S&P 500, moving down strongly. And we have the derivative oscillator losing momentum, still positive, still in an upward trend until we get that all-important weekly vertical crossover. Remember, folks, when we have crossovers going up or down, they're showing huge waves pushing in that direction. When it's down, the market typically goes down for many, many weeks. When it crosses over going up, the market typically goes up for many, many weeks. And as we look back in time, we can see how accurate that has been in the recent past. And when the charts work, we use the charts. Now, people say, well, how long will this work? It works until it doesn't. And there are certain stocks and ETFs that you can't chart. They're too happenstance. When that happens, you just don't chart those. But the S&P 500, the NASDAQ 100 is represented by the Qs, TLT, 20-year bonds and gold are chartable. That's why we pay attention to them every day. Okay, so we see the weekly down. Now we're going to go from the weekly to the 2-day. What do we see there? Well, we see it's continuing to trundle down. And again, not as low over this last 2-day candle as we saw the prior 2-day candle as far as the wick goes. And we see that the derivative oscillators are lost a little bit. Well, no, derivative oscillators still moving down. Price percent oscillators lost a little bit of its downward momentum. We go to that 4-hour chart. And of course, getting close to crossing over going up. Hasn't happened yet. Some indecision tending up in the morning. Big up candle in the afternoon on the NASDAQ 100. Things just sort of continuing to build. And again, no trade because the 2 days down, weekly is up. Continue to watch and see what we see. If we have a weekly vertical crossover by the end of the week, we will let you know. Okay, going to head from stocks now to bonds. Bonds up for the day, 0.61%. And we can see that the blue price percent oscillator is pulling away from that red signal line. We can also see that the derivative oscillator has now gone positive on this weekly chart. It was negative the last 2 weeks. And of course, a big up candle so far in 20-year bonds. We go from the from the weekly to the 2-day. And remember, we had that 2-day chart crossover going up back on the 7th. And again, connected 4 candles, nice 8 days of good up movement in bonds as far as the 2-day candles go. Another thing we had happen that we like to see is when you have a crossover. We have just found that when we found this over the years, we've not just found it, we have found that over the years, when you have the price percent oscillator and the derivative oscillator crossover at the same time, tends to make for a better continuation signal, means that there will be several additional candles typically of movement in that direction when they both cross at the same time. When they don't cross at the same time, a little more happenstance, maybe meaning you're getting into the move later than you need to if the price percent oscillator and the derivative oscillator aren't crossing at the same time, or not as strong, not as definitive, as clean a move. So we go from the 2-day chart to the 4-hour. What do we see in that 4-hour chart? Big up movement in the morning, a little bit of a pullback in the afternoon. Now, what we've been waiting for, and the reason we've not jumped into bonds, even though the 2-day and the weekly are both moving up now, is because we had that latest 2-day crossover. We can see that on our 4-hour chart a few days ago, but we've not had a pullback yet. And again, when we're looking for a classic way of getting into trades, when both your weekly and 2-day are moving in the same direction, the weekly's been moving in the same direction for a while, the 2-day has sort of pulled off moves and then moves back, we have to wait for a pullback in the 4-hour chart. The 4-hour chart is our trigger chart, and we need it to cross over going down and then cross back over going up, since this is an up move. That then gives us a safety point for actually jumping in. The problem is, the minute the 2-day chart crossed over going up, we didn't have a jumping in point here on the 4-hour chart. We just didn't pull the trigger to jump in at the wrong place. So we use that 4-hour chart as a trigger chart. You want to know more about what it is I'm talking about, what it is we do, I would very much encourage you to buy our book. We have a book for sale. You can follow the link in the show notes. If you're listening on iTunes or any of the podcasting services, look in the show notes. You'll see a link to buy our book. You'll also see it in the show notes that you get if you receive the email every day. We've had some more trouble with the emailing service. We had it a month ago. Our technicians worked on it, got it fixed, and now by darn, it's done it again. And I can't explain why, but everything is always available on YouTube. You'll also see the links in the YouTube show notes too. And you'll see them in the show notes at chartingwealth.com. So the links to purchase the book is there. Also links to be a Patreon supporter. And you get special stuff with a Patreon support. If you're in that intermediate level, you even get a personal telephone call from me once a month to see how you're doing and to help give you some personal advice. So consider Patreon support. In addition to all the special training, the monthly Q&A call-in that we have, and my review of the charts that you are interested in, both stocks and ETFs, you get all that. So again, we appreciate all of our Patreon supporters. That's where we are as far as what we're seeing happen with 20-year bonds. We are waiting for a pullback on the 4-hour chart. Then we'll jump in and ride that pony if it presents itself. And again, if it doesn't present itself, then guess what? We don't get in. We just don't. We are not going to rush in and lose money. There's so many good trades all the time, or enough throughout the course of the year, that if you play the good ones, you don't have to play the questionable ones and lose money. Again, we're not going to be fools. If God's blessed us with money to invest and to trade, when you get good at this and actually are using real money, and that's your own decision. Again, we're not a stock calling service. We want you to get good at this, though, and be ready to actually, at some point in time, use all the knowledge we've taught you, everything you've read, studied, all the practice trading you've done, developed your own way of tweaking things out. Then and only then can you use your own money however you want. Hopefully, you'll be investing it. You'll be making money. You'll create your own virtual printing press. And don't forget the real game day that we are training for, where fortunes are going to be lost by others and hopefully gained by us, is when there's a systemic market crash. And there's always a crash on the way. It may be sooner than a whole lot of people think. And again, there's a lot of people out there that are very concerned where things are in the world, and any trigger point could cause it. And when that happens, we're going to be ready, my friends, to pull out of the market and consider wherever the bull markets exist, whether that's in gold or bonds, whatever it may be, or just be in cash and let everything crash and buy it back cheap. Anyway, we want to be smart about that. That's what we're training for, in addition to the opportunities along the way until that day comes. Now, let's go to gold. Lastly, gold is the only thing down for the day, 0.06%. We look at gold, we have an up candle for the week. We're still, of course, in a weekly vertical crossover going down, derivative oscillator losing downward momentum. That price percent oscillator is not quite flat. It's heading up just a little bit toward the red signal line. Doesn't look like it's going to cross over going up, however, before the end of the week. If it does anytime soon, if it does at all, it could bounce off that red signal line and move back down. What do we see going on the 2-day chart? Well, we don't have a trade in gold because the weekly's in a confirmed down move. The 2-day, since it crossed over going up back on the 2-day candle ending Thursday, the 9th of May, is actually going up. And we have 4 up candles, 8 days of up movement. And we see the derivative oscillator moving up. And of course, we saw that crossover occur on the 2-day chart the same time the derivative oscillator flipped over. We look, however, at this latest candle, and we can see that the wick on top, the top wick on both the candles, this latest candle is not going as high as the prior. Now, the body of the candle did move up further. Derivative oscillator is still moving up. Price percent oscillator lost a little bit of its steam over here, not moving up at the same angle, but still moving up quite strongly. We go to the 4-hour chart. What do we see? That's where we see where the strength came from. A big bump up back on Monday, a little bit more in the afternoon on Monday. Big bump up Monday morning, a little bit more. This, of course, is in the market, was hammering down. Is it an interesting? Gold was hammering up. Why? Because gold tends to be a safe haven many times, as do bonds many times, when the market itself is going down. This might be where we find our bull market. When the market crashes, gold may be where we want to go. People always say, why do you follow gold? You do stocks and bonds. What's gold about? Gold has been a store of wealth since the beginning of time, when men first dug it out of the ground and fell in love with it. And it is a true store of value, has been money, will be money, probably forever. And again, we'll continue to follow gold. So what do we see happening over the last 2 days in particular? We see a sideways slide in gold. The price percent oscillator is just about flat. Derivative oscillator losing upward momentum, but again, they're still positive. So what will we do? Continue to keep our eye on things and see how gold sorts itself out. Will the 2-day chart rotate back over going down? Will the weekly chart rotate over going up? We don't know. We'll wait and see how it shakes out. Markets are in a bit of a flux right now, aren't they? Well, guess what we do? We watch, we wait, we let them sort their way, we let them sort out, and then we follow established trends. And we have methods for doing that. That's where we are, folks. 10 to 15 minutes a day is all we ask for greatness. God bless you. Please don't hesitate to write us, cw@chartingwealth.com. If you happen to live overseas, for some reason your credit card will not work at Square where we sell the book. So instead of going to the link in the show notes, email me, cw@chartingwealth.com. Guess what we'll do? We'll send you an invoice from PayPal and we'll ship your book wherever you are in the world. God bless. All the best from the whole team here at Charting Wealth World Headquarters.